Good evening, Ken Long from Tortoise Capital Management with a review of the daily trading plan for February 6, 2012. Begin with a look at the market health check. The vertical blue lines are 10, 20, and 30 days of look back. The solid purple line is resistance at the swing high of 137, which is an annual high. A close above 137 would be significant. The horizontal red lines are previous levels of support that have held. The black line in the middle is the regression line, the 30-period regression line. The outside black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period. We have a very narrow channel here, which is a symptom of bull quiet market conditions, which is favorable for swing and longer-term trading. Today's price action keeps us right at the fair value as defined by the regression line. We're right in the middle of the regression line, our regression channel. We have price better than the 10-day moving average, better than the 50, better than the 200-day moving average with a tight band. So that's very favorable. Williams percent R, we're overbought. We can stay overbought for a long time, as you can see on the last channel excursion, so that's not a negative. It just says that we're in a bull. The percent price oscillator, which is the equivalent of a MACD histogram, is favorable. The jaws are starting to open up as the market bounces off that pullback to 130. That still looks favorable. The slope of the regression line itself is still strong and hooking upward. That's favorable. We are less than 5% away from that resistance level, so we're in the noise range, and that's favorable as well. So all signs point to a continuation of the bull. Shifting now to the daily trading plan. Bullish quiet on an annual basis, 62 out of 100 on using weekly RSI 14. That's favorable, upper end of normal. On a 10-day basis, we're at 96 using the 10-day NDX, and you can see that we're still overbought. And we can stay that way for a long while. Percent stretch above the 200-day moving average is 7.72. That's green, a strong bull. The slope of the 50-day moving average is 0.99. That's coded green. That's exceptionally strong compared to the last 6 months. So that's also bullish. ADX at 28.6 is bullish. The ATR percentage at 1.07 is quiet on a relative basis. That's bullish. We have no signals in the overreaction or channeling system. The pivot points you can see are between, they stretch at 135.38 for R3 to 133.33. That's a very narrow channel with the pivot point at 134.25. You see volatility at the low end of the last 6 months, so that gets us into quiet by a healthy margin. 10-day max pain candidates: Pfizer, Travelers, Procter & Gamble, ExxonMobil, and McDonald's. We'd be watching for ExxonMobil carefully because of the strength in the energy sector today. ExxonMobil should be on our short list for attention tomorrow. Among the ETFs, it's the VIX, natural gas, oil, USO, and gold miners. 10-day min pain, these are the ones that have been the strength leaders: Disney, Bank of America, Cisco, Home Depot, Alcoa. ETF 100, oil, service, energy, blended commodities, and corporate bonds. We have a 551W pattern in gold among the ETFs, and for Merck in the large caps. Merck is also a triple screen. An entry above 3840 is what's called for in Merck. Channeling system, we have Pfizer as well. Moving on. The top 5 max pain range compression in the Dow 30: Pfizer, Travelers, ExxonMobil, AT&T, and Procter & Gamble. You can see Pfizer has been almost washing out here. Percent loser between 1 day and 10-day over the look-back period. Bank of America has been an exceptional winner over long periods of time. So if finance was a big loser today, And there's a distinction here between American Express, which was a exceptional loser, and Bank of America, which was an exceptional winner. So potential pair trade there. If finance is good tomorrow, I would look to see momentum in Bank of America to continue. Hewlett-Packard was horrible today in the Dow 30. It and Boeing were among the percent losers. If there's weakness in technology, I'd look for Hewlett-Packard as a potential short. In the ETF 30, a handful of dojis. There's 1551W in gold. Max pain range compression is the energy sector. And the VIX, so you get the VIX, oil, natural gas, utilities, and consumer staples. That reflects a continued shift towards the growth end, away from staples and towards the growth. Today, the strength was in treasuries and energy sector. Treasuries was a surprise today, but had a great intraday pattern. So we'll be looking for more momentum in there tomorrow. EEM was weak, the emerging markets. There was also weakness in Brazil. And so continued weakness in Brazil would be a short in that area. You can play emerging markets double inverse with EEB, or EEV, excuse me. That's the double inverse of EEM. So if we see more weakness there, you can play it on the long side with EEV. Taking a look at the frog candidates, there's still a dozen that are above 3.0. Disney, exceptionally froggish at a 4.1 frog quality number with only a 15-cent standard deviation. ExxonMobil will be an interesting play, as well as Chevron. Chevron with only a 50-cent standard deviation offered a 3 or 4 R potential today in the frog for those unlike me who had been able to concentrate on it. Shifting to the signal-to-noise ratio, silver, the VIX, natural gas, Procter & Gamble on the high end. Taking a look at the market mosaic, the regression line R squared is still at 0.93, so exceptionally good descriptor of the strength of trend of the last 30 days. It has crossed over its own 10-day moving average at a distance greater than 1 standard deviation from average, and that is an alert to be ready for sudden surprises to the downside. If that happens, I'm looking at the VIX and then going short the weakest sector in the U.S. And those are the highlights from the daily report. Keep your risk measured and your powder dry.